Hey, this is Andrew Kuhn, and you're listening to the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, timeless investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along. Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn. Focus Compounding on the #1 value investing podcast in the world, soon to be the #1 YouTube value investing channel in the world as well, and on our way to being the #1 educators in the value investing space on the internet, sitting next to the main teacher, Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else. Hey, if this is the first time that you're tuning in with us, be sure to check out all of our work. Go to my Twitter at Focus Compound, hit that follow button, and be sure to subscribe on YouTube. Thumbs this video up. Check out all of our content. We have a bunch of free content on focuscompounding.com. We simplified the website. Geoff is going to, if you're on the premium side of things, which if you want to join, use the podcast promo code. They'll take some money off of the subscription price, and definitely as long as you do stay a member every single month. But Geoff is also uploading free content as well, or writing free content as well, just on investing topics at focuscompounding.com. Hit that blog button, and you'll see all the free content if it doesn't require you to log in. Also, we are going to be in Berkshire, or in Omaha, for the Berkshire meeting this year, May 2nd, the week of May 2nd. So reach out to Andrew at focuscompounding.com if you're interested in learning a little bit more about our money management services, either through the SMA or the fund. We'd love to meet up for coffee, meet in person, and go over that. So in today's podcast, we are going to be talking about portfolio management and pretty much everything that comes with that. So like idea generation, I guess the structure behind like creating a watch list, how you think about a watch list, position size, the type of companies that you want in the portfolio, the way you think about like hurdle rates and IRRs, and everything related to that. And we run capital through two different vehicles, the SMAs, and we have a fund as well. I think both are actually unique in that you could do a lot of different things in the fund that you can't do in the SMAs. And I think we probably think about the two vehicles differently. But let's talk about, portfolio management and then really relay it back to how you would think about it as an individual investor. Now, as the way that we manage capital, if you're always getting inflows and stuff like that, I think you probably think about it a little bit different than if it was just yourself or your own personal money. So maybe let's just start from the beginning, right? So idea generation. We've talked a lot about idea generation. We read a lot of blogs. There's so much content that we have on this on the internet. So you could just either search through the podcast or, search through YouTube, just read the titles and find it. We read a lot of blogs, the Value Investors Club, Corner Berkshire. Even though Geoff has been reading on Corner Berkshire for a very long time, and he's only found, I think, one idea off of that website.
One idea that we bought that I wouldn't have otherwise known about. There are other ideas.
Okay.
I've owned other stocks that have been written up at Berkshire, Corner Berkshire and Fairfax. But that's not where I found it.
Okay, so Value Investors Club, screens, Portfolio 1, 2, 3. Then there's other sources as well. Value Line, if you're into that. Any sort of like OTC manuals, just stuff that I guess would be different. Twitter, ironically, is a pretty good source of idea generation. I would say it's probably much better source for large caps and stuff like that, which is great as opposed to stuff that we follow. But then like networking as well, right? If you do find investors that invest very similar to the way that you do or think about it the same way that you do, it's good to talk ideas with them, right? Did I miss anything for idea generation?
No, I think that's pretty much it for idea generation.
Watch list, right? And I think watch list is very important to the process, right? Building a watch list to really systematize the process and, just kind of, look, you should be doing the work when markets are hitting. You do the work all the time, right? But I was talking to somebody the other day and I thought this made a lot of sense. You do the work when markets are continuing to hit all-time highs. You don't slack off then. So then when there's volatility in the market, you can act decisively.
Absolutely. So our watch list, basically, there's some exception to this, but in general, I like to write up an idea and then I've written it up. It's on the website, it's on the Stocks A to Z page, and then I can revisit it from there. So I know what I thought about it. So as soon as I can write up a stock, I do that. Occasionally there are stocks that we haven't written up just because they're so obscure and stuff that we don't want to write up some stuff, and especially things that will go public beyond just our website. So there's some stocks that we won't talk about on the podcast and stuff that we might be looking at, and that's mainly because it'd be hard for us to get shares and things. But other than that, I write them up. That's how they get on sort of a watch list, and I have a revisit price, a price that I'd be interested in looking at it again.
Yeah. And what I do with that is I have it in a spreadsheet through the data thing on Microsoft Excel. And then, through a couple different formulas, it lets me know when it gets close to Jeff's revisit price. And I could let him know, hey, this is trading close to your previous revisit price. But I think it's good just to have that all systematized. Like say you're looking at so many different companies, sometimes it's probably easy for stuff to fall through the cracks. And I think having your own process with that is good. Because like I said, when there is volatility, you could be decisive and have your thoughts on it. I mean, for example, if something happens with a company that you've looked at, you could revisit your write-up. You already know what you think about it, and then you could be decisive.
Yeah, and we try to focus on the write-up on stuff that isn't price. I try to do a lot of thinking about a stock that's mainly not on price. The ultimate decision whether to buy it or not now is based a lot on price, but try to not come in with that sort of thinking, because that's the least useful bit of information in the sense of it's the least durable. 6 months from now, the price could be a lot different, and so it's not that useful what you thought about today's price. But knowing things about a good business and stuff don't change that quickly. So if you're right about the business, then you may get a different price that you could buy it at later.
Position sizing.
Yes.
A topic among many investors.
Yes.
What are your thoughts on that?
Well, we do it differently in the fund versus the managed accounts. The managed accounts, we basically try to equal weight them originally. So they're pretty equally weighted to start off, is basically the answer. If we got a new client today, they'd be equally weighted basically in the stocks that we would be willing for them to own. And then after that, we would try not to react that much to moves in the stocks as much as other people might. So we don't trade around it that much. It's not like we would sell a lot of the winner and buy a lot of the loser in their portfolio, which is maybe more what some value investors would do. I don't know exactly what they would do, but I think they change the position sizing more, whereas we wouldn't do that. We just try to have a certain level of diversification, I would say, among equal ideas, and try to cut down on the number of total ideas we have. I think the biggest risk is usually for me is having ideas that aren't good enough in the portfolio rather than sizing them at different levels. Yeah.
Where's the logic come from with that?
I don't know that I've been able to add a lot of value in terms of position sizing. There have been a couple of times where it has worked, but for the managed accounts is difficult because there have been a couple of times where it has definitely worked that deciding to size a position much larger has paid off in a really big way. But that happens for me maybe every 3 to 5 years. That there's one idea that's so much more attractive than other ideas I've seen. But it does not happen that every year I have an idea that I like a lot better than the other 4 or 5 ideas that we have. So I may have 5 ideas that I like fairly equally, but I can't find something that I'd be like, oh, I should put half my portfolio or something into this. That just doesn't happen on a yearly basis. It happens occasionally, maybe at best every 3 years. And then, personally and stuff, I have done that where I've put a lot more into something that I liked a lot better, and that has worked out. Those have, outperformed and stuff like that. And especially not just outperformed, but been safer and things like that. Yeah.
What about Greenblatt, right? He was the guy that was super concentrated at Gotham. I think, 4 to 5 stocks? And now obviously he runs the magical formula and all these different mutual funds and stuff like that where they own hundreds of stocks.
Right.
Why do you think that happened?
Because I don't think he's really in the business of picking stocks anymore. Yeah, that happens to a lot of people. They don't want to do it anymore. So I think that's what happened.
It's more of a diversified
I think
approach.
If you're concentrating, you're picking stocks.
So he already got rich and...
Yeah, maybe. I mean, who knows? Obviously, his performance was better the first way than the second. I don't think the second way has been very effective.
What about Buffett in the way that he invests capital, right? So you were talking when you wrote a little bit about this, how Apple, a lot of times he'll buy and then he doesn't buy anymore, right? Over time, as he gets more capital and stuff like that. So it's like a true holding company. Do you think individuals should do that with their portfolios?
Yes.
Okay, so explain that.
And it is what we do in the fund.
Yeah.
To the extent possible. There's some things with the fund. The fund, we also have to manage the issue of liquidity and stuff, because with the managed accounts, they're each person's individual account. So it's not an issue of the fact of redemptions and things like that in a fund. And this would be true for anyone running a mutual fund that's open-ended or something like that. They'd have the same issue. So basically, though, we buy a stock up to the point where we want to stop buying it. And then as more money would come in or something, we wouldn't necessarily buy more of that stock if it had gone up.
Because there's a lot of managers. So like, let's say they have a portfolio of like 10 stocks, right?
Yeah.
And it's, let's say all the capital is, allocated or whatever. And then they get some more inflows. A lot of times what they'll do is they'll percentage base it, into the same positions and stuff like that.
No, we don't do that.
And what's the logic behind that? I mean, because I think that's a good point for a lot of individuals that if they want to think about their own portfolio is like, Geoff Gannon's personal holding company or Andrew Kuhn's personal holding company or whatever your name is, that's an interesting way of going about it.
We try to buy the thing that we think looks most attractive at the moment. So if we bought a stock and it doubles or triples or whatever, then it's likely that it's not as attractive to us as something else that we can find now. It's also possible, even if it goes down, that it's not attractive if other things went down more or if we found something new. So we're always trying to focus on buying the thing that we like the best at the moment. And the fund, for the most part, we try to basically be buying one thing at a time. We don't have to buy a lot of different things at the same time. Now we do sometimes for like liquidity reasons, we're just not getting as many shares as we'd like, then we're buying multiple stocks. But in terms of like, if it wasn't for that issue, we wouldn't actually be buying multiple stocks at the same time. We just buy a stock till we got the allocation that we liked and then we would stop basically. Yeah. So, I mean, that's the Berkshire approach. That's the approach that I kind of favor. I think it makes most sense. It's obviously impossible in separately managed accounts. You can do it initially for a new client, but then when you get another new client, then of course that new client has to have shares bought for them personally. That's how the accounts work. They're separate so that they're not getting a percentage of what you already own. Whereas with a fund, when someone joins the fund, they're getting a percentage of what you've already bought. So their allocation, in a sense, doesn't require you to go out in the market and buy more. The same way that like buying into a holding company or closed-end fund or something would work.
What about the type of companies?
So that's the hardest part. That's why we don't have enough.
I saw a lot of people this past week with the coronavirus, talk about, for example, them being proven staying away from companies that have like a lot of debt, relative to EBITDA and stuff like that. Because when there's volatility and just stuff like that, it tends to be reflected more in like the stock prices and stuff like that, and the business in general, but obviously short-term stock price. Yeah.
Well, that's true. You saw that a lot. Things that wouldn't necessarily be affected by virus any more than anything else fell more because they have more debt, they're riskier, they have higher beta, they're more speculative, or I mean, like for instance, I think Twitter was down, right? So Twitter is a stock that should have like no effect. I mean,
Twitter probably like tripled over the past couple of weeks.
Think of what
the
should
activity
have less of an effect from that. Now, ad markets and things can hurt you, but a reason for that is who's in the stocks. And we talked about this a little bit before. Beta.
Yeah.
Beta basically, when you correlate with other things, I think that a lot of that correlation between things that you're experiencing in stocks is not really correlation between the underlying businesses, but correlation between who owns it. So if some of the same people own Twitter and Tesla and Exxon or whatever, they might all fall at the same time because those people are trying to reduce their allocation to stocks generally or something like that, And so, for instance, you could have, so you see that a lot with things that don't necessarily make a lot of sense. Like I think you saw, take an extreme example like cannabis or something. Cannabis related things sometimes drop a lot on stuff that shouldn't have anything to do with cannabis, but they're just a risky sort of investment. And it's not just that they're risky. I think they're potentially more in the portfolios of people who are taking a lot of risk.
Yeah.
And so when those people choose to sell things, that's one of the things that they sell. Yeah. So we do tend to own overlooked stocks. That's our thing. They have lower betas, especially they have lower correlation with the other stocks and with the market. And there's different reasons for that. In the fund, the reason we know everything we own in the fund is had a non-typical way of going public, basically. I can't think of anything that had a typical IPO. So the company could be around for a really long time now, but its shares weren't distributed among the public in the way that a major like IPO happens. So that probably reduces the kind of ownership that would trade it frequently and stuff like that. In other cases, it's less clear why there's low amount of like why the beta is lower and stuff. I don't know in some cases why it is. It's hard to say. I don't know exactly. But everything we own does have lower share turnover. So there's some reason for it. And it's not always clear why. I can think of somewhere. I'm not sure why it is. Sometimes it's because I think it's in its own niche industry or something, So like it's not something that
there's fact too. If it's like a microcap, right? That's could be one. It's a smaller company. But obviously there's a lot of liquid microcaps. But I guess that's more of like the speculative business types and stuff like that.
Yeah. So, but we've owned companies that are fairly big and have considered ones that are fairly big, but I can't think of ones that we've considered that are fairly big and are also like part of a pretty big industry. Mm-hmm. That seems to be more the issue. So like, restaurants, retailers, whatever things, people might be buying a lot of them in baskets and things like that. So
if you had to describe just a perfect business, what characteristics would that business have?
Well, the business would be predictable. So especially it would have high customer retention.
So like a very sticky business.
Right. It has high customer retention, which either means that you have contracts and things, or it's just sticky because of switching costs, or you have like a strong brand or something like that, It would have pricing that isn't very sensitive to the market. So it would be the least marginal of the companies. That's generally pricing. Sometimes it's cost advantages. So let's say I was going to invest in an auto insurer or something, right? You'd want to invest in like Progressive because they're the ones who are likely to have a combined ratio below 100 in years when the industry isn't doing well that way. So sometimes it's a cost advantage that way, but a lot of times it's a pricing advantage where, say, Coke or something is the least likely to lose sales just because it's a penny more expensive than other things, right? So if it's harder for competitors to take away your business by lowering their prices, then they won't lower their prices against you, in the same way. We like things like banking and insurance and stuff that have pretty high retention rates, and that people generally don't leave. Generally, all of our stocks have higher retention rates. There's an exception I can think of, but other than that exception, they have very high retention rates. And even in that exception, there's sort of like a local aspect to it where you're not retaining your customers very well, but you're holding the same local market share, and that can happen too. Local kind of monopolies, duopolies, and things are attractive that way. The ones that are least attractive to us are kind of the global things that compete on price. So if you're global, you compete on price, and you don't have like high customer retention and things like that, which is often what happens when you compete on price. So like global commodities and things are something that we wouldn't be that interested in.
Predictability. Yeah. So that's I would agree. How do you think about like IRRs and stuff like that? Like when you think about like crafting a portfolio, for example, that you hope, would outperform the market. I mean, how do you generally think about it?
We almost always think about over a 10-year period and calculating on the basis of how low is the hurdle that they have to clear? How sure am I that they will accomplish this? So it depends on the business, though. Like I could be looking at an ad agency or something now and say, well, even if it requires them to have 2% growth for 10 years, that might be tough. They haven't had that recently. On the other hand, if we were looking at, Starbucks or Domino's or something, you might factor in a certain amount of growth that would be likely just from opening things in new countries or whatever. So we basically work from like trying to figure out, let's say the P of the stock is 5 or something. If it goes to 15 over 10 years, which is like a normal PE, then we could make all of our return that we need, our 10% return a year, just from that.
So you're handicapping it, right? So it's like the reverse engineer approach to it, almost like a reverse DCF in a way, right? What's the market currently pricing it at?
Yeah.
And,
But if the stock already had a P of 15, potentially I could still buy it if I felt really sure it was going to give me like a 10% annual return.
But you're betting more on growth.
You're betting on growth,
as opposed to, because you wrote an article once about handicapping stocks and how, generally speaking, to be conservative, you usually assume a market multiple, I guess, in the terminal value or whatever,
Right. And that is
like the end of 10 years.
Yep, that's generally what we do. And because you could argue that we've talked about this before, like in valuation of certain things, you could argue that some stuff is worth very high multiples of free cash flow and stuff if you just do like a DCF type approach. But then what you're actually doing is you're assuming that in 10 years the PE on the stock will be like 25, 30, not 15, which could be justified.
Yeah.
I mean, if you look at what Buffett invested in stuff, he doesn't 10 years after you buy it usually have a stock that's at a 15 PE if he was right about the business.
No, and I think so if you're not betting on, the multiple expansion, you're probably betting on growth. But, if you could find situations where you're not betting on multiple expansion, I mean, it's just like the way I generally think about it, right, is I think most investors, they want to buy a stock at 50 and then that they think it's worth, $100 and there in between is their margin of safety, right? But if you are buying a company for $50 and you think it's worth $100 and, it's trading at a 10% free cash flow yield. Well, if this stock does nothing over the next 10 years, at least you're going to get that build up in market cap. So I think it's kind of like the reverse engineer approach when you come to like handicapping it, like how you just kind of said, if you're not betting on if you're not betting on the current multiple and stuff like that,
Yeah, I'd say in the management accounts, we have 2 stocks that would beat the market without any growth, just if their multiples expanded to that point. Now, of course, if they literally have no growth, there's difficulty in getting their multiples to expand to that level. It's less likely. But in theory, you don't need growth from them. And then we have two where I would say it requires growth. We don't have any that require like above GDP type growth, really. As long as they could hit the same sort of growth as the overall economy, probably, we'd be fine in terms of hitting, say, a 10% or better return in the stock, or like beating the market, things like that. Real growth stocks, sometimes you need to have, like, there are some stocks that are priced so that if they grow less than 10% a year for the next 10 years, you actually will lose money in them because you're buying at a multiple that's 50. And that means that if it contracts to even 20 or something over those 10 years, then your growth of 10% a year basically gets eaten up.
Do you think investors, when they talk about like Warren Buffett, like paying up for businesses, they think differently about that than the way that he does? Because I mean, even if you take Apple, for example, what was it trading at? Like 12 times earnings, 15 times, not even 15, I don't believe, when he bought into it.
I can't think of a lot of cases where he's paid more than 15 times earnings for something. He may pay more for like the companies that they own entirely. That's a little harder to know. His returns on them haven't been as good as his stock returns, I think.
Because if you see a lot of the way that people, they do the math on paying like 20 to 25 times earnings for a very high growth business, oftentimes the exit multiple or whatever is always like 20 to 25 times. Like they don't factor in a normal multiple, which again could be justified, right?
It could for certain companies. If the company has almost infinite returns on capital and stuff, it's totally justified. If it keeps growing a little bit, though, you do still need it to keep growing a little bit in each of those cases. So if someone was saying, should Omnicom traded that when it was a successful growing business and stuff, it maybe should have a PE of 25 instead of 15. If you're talking today, you might think those things about Facebook and Google, things like that you believe they deserve to have higher multiples that way. On the other hand, usually people don't. I think a lot of that is factoring in the already existing multiple. Yeah. Because they don't hear as many people say that about Bank of America. And yet, in terms of the economics of the business and stuff, 10, 20 years from now, let's say 20 years from now, I'm not sure that things like Facebook and Google will be growing faster than Bank of America. I don't think that ads will be growing faster than banking. So if you really believe that, then, the ROEs are a little bit lower on banking, but not a lot lower. So I don't know why you would be plugging in a PF 15 as your exit for some of those stocks and 30 for the others, unless you're talking about I'm selling within the next 5 years or something, which is different.
It's like Chipotle. We've talked a lot about Chipotle on this podcast. Like to go through like the 10K and stuff like that, and like accounting and stuff. And with it trading, remember when Chipotle sold off? A ton. But it didn't even sell off to like, it was just the multiple. I mean, I don't know, of course, sales were hit as well. But the multiple was so high before, it's always been like 60. So you're betting a lot on future growth, is what I'm saying.
So we have Chipotle open right here now that we're looking at. Yeah. It's obviously a wonderful business compared to something else of that same size and stuff. But if we look, let's see, what's Chipotle's gross profit right now?
34%.
That's their margin, but their gross profit is about
1.9 billion. Sorry,
1.9 billion. Okay, and let's see their operating profit. So then let's see So a company about the same size, we just did Carnival. So Carnival's about the same size as Chipotle, for instance. And if we put in Carnival instead of Chipotle here, the market caps are the same. What's the gross profit on Carnival?
7.9 billion.
Right. So we're talking about 4 times.
Yeah.
4 times higher than Chipotle.
And it's trading 8 times earnings.
Yeah, and if we did revenue, it's not going to be completely different. We did revenue, if I did operating profit, all those things. So I'm not saying that Chipotle isn't a better business than Carnival. It is. And if it was at one store, then that would be totally justified to pay 4 times more for it because they're going to now open several thousand stores that have the same economics as this one. But are you going to double and then double again instead of Chipotle's store base? I don't know. It's just that the multiple thing becomes a really big part of it. And that's what you have when you have with very big companies. Chipotle is a huge company, so it's more easy for me to say that about it. If Chipotle was a $230 million market cap instead of $23 billion, it's very hard to know what the right multiple is because it could grow like 1,000-fold or something. It could literally go from a few stores to thousands of stores,
I wonder what Munger paid for Costco.
Yeah, I don't know the exact price they paid.
I don't think I've ever seen anyone talk about that either.
He kept it, but he didn't pay the prices that people are talking about today. He's talked about that he'll like hold on to a stock even if it goes up a lot in price.
Yeah, let's see what 33 times earnings.
Yeah.
Do you even know when he bought it, Costco? Yeah, I don't even know. I've actually never seen anybody do like a report on it or like a reverse engineer on it. Maybe I should do that.
So that's the problem that you have with all of these things is that like the multiple stuff. So would we buy Costco at 33 times earnings? No. So, I mean, you can learn about Costco and try to figure it out. But it's just that price is way too high for us.
Now, what about people that say it'll always trade, above an average multiple like 25 to 30 times earnings because it's a better business and stuff like that. So if you value, if they do have growth, you could still get a return on the stock. Do you just think that's much more?
So during the good periods for Southwest Airlines, Starbucks, Walmart, let's use those as examples, those all did trade almost the entire time at high multiples. I don't know if 30 times or something, like the levels we're seeing for Costco.
Yeah, like Starbucks was always cheap.
They did for decades, right?
Yeah.
But those are things that can grow a very high amount. And the other thing is, of course, their returns declined. I mean, like for instance, Walmart's returns, as far as I know, have been declining for 4 decades or something in terms of probably what they're getting on their incremental returns. By the way, so is Berkshire's. And like Buffett said, his stock results probably as an investor have been worse almost every decade from the decade before. They peaked in the 1950s. And that's true. But so you do want to like pay a lower multiple over time. There was probably an opportunity, a couple years ago in Starbucks to buy. They started buying back a lot of stock and stuff. There was an opportunity where the stock looked really cheap to me, and as it turned out, should have definitely bought that. But even then, it's fine if you have a long runway ahead. It really doesn't matter what the size of the company is, because of course the problem would be that I would have guessed that Starbucks would have run out of room to grow or something much earlier, or we might have guessed that about Chipotle or whatever. But then you have other ones like Cheesecake Factory or whatever, where they do stop growing much earlier. So it is a question of seeing how far that runway is for the growth, because that's a value creation. It's how high is their return on equity and stuff, and then how much can they reinvest in the business. We'd always prefer to have a business that can reinvest it, that can grow over time. So, but most of the things we buy into, we can't factor in much growth. If you can't factor in growth above like the normal economic growth you're going to get, you're probably going to be buying things at 13 to maybe, if you're really pushing for, you feel completely sure that the growth will happen, 20, 25 times earnings. If you had something that you were positive will grow as much as the economy forever or something, maybe you could pay 25 times earnings, but you're going to have a lot in that range of, probably about that. Let's say 12 to 24 times earnings or something. That's usually going to be the range in which you could buy like predictable sorts of companies or whatever. And I think Buffett's purchases are all like basically in that range. Of the things he paid up for. His idea of paying up was paying 12 to 24 times earnings. And I think much more the 12 than the 24.
Yeah, no, I agree. And Apple, like I said, is a pretty good case of that. Well, I don't thank everybody so much for tuning in with Geoff and myself. We are going to be in Omaha the week of the Berkshire meeting, as long as it does happen, right? May 2nd. So if you are a potential investor and would like to learn a little bit more about our money management services, either through the fund or the SMA, definitely reach out to me, Andrew at focuscompounding.com. I want to thank everybody so much for tuning in with Geoff and myself. Be sure to subscribe button, thumbs this video up, leave us a rating and review. That goes a very long way for everything that we do, pumping out a ton of free content, and any sort of support that people leave for us definitely goes a long way. I want to thank everybody so much for tuning in with Geoff and myself, and we will see you in the next podcast. Hey, this is Andrew Kuhn, and that was the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along.